In this week's video, we'll review the latest charts, signals, and studies to help us answer the question, is it time to start buying tech and growth stocks? Want to be respectful of everyone's time here. These are the topics that we'll be covering. Note, tech and growth will be covered in the latter stages of the video. Let's talk about an incredibly important topic, global liquidity, and see what we can learn. Chart on the left side of the screen comes from Cross Border Capital. Their Twitter handle is here, Cross Border Cap. Chart shows the ratio of world investors' equity holdings to global liquidity. The takeaway summarized here. World stock markets appear well supported by global liquidity. Present day reading comes in about halfway or a little bit less than halfway up this box. It's also a possibility that this move here, A, B, C, D, E, is a larger fractal of this smaller move here. After this period of consolidation, the ratio did expand significantly, but really good things happened in the stock market between 1996 and the spring of 2000. We put all of this, the fractal, in the more interesting category relative to useful. This is the key takeaway on this topic. Now let's shift gears to Dow Theory and see what we can learn. So chart of the Dow Jones Industrial Average dated April 8th. Recently printed a new high for the rally off of the March 23rd, 2020 low. And the same thing can be said from a quote-unquote confirmation perspective in the Dow Jones Transportation Average. Some argue that Dow Theory is outdated and they prefer to look at the semiconductor index, which also recently made a new high for the rally relative to the March 23rd low here. All of this speaks to the probability that the bull market is intact, and we have to keep in mind that under the definition, the standard definition or accepted definition of a bull market, the S&P 500 conceivably could drop 19%, and a bull market could remain intact. Ultimately, Dow Theory speaks to the longer-term sustainability of a bull market. Like anything else, it speaks to probabilities, which is significantly different from certainties. 5 new signals this week and 5 new studies. Let's take a look at study number 1. Is NYSC new 52-week highs minus new 52-week lows. The chart is dated April 5th. We thought it was probably relatively rare to see a rapid move like this from approximately negative 150 up near 300. So we wanted to know, since 1980, how many times has a similar move occurred in a compressed time frame of 15 trading days or less? The recent move occurred in only 6 trading days. We thought this move in 6 trading days was probably relatively rare. As it turns out, going back to 1980, it's only happened 2 previous times. Both of them occurred in calendar year 2013. Thus, it might be helpful to know, how did the stock market perform in the 2 previous cases, the only cases seeing a similar move going back to 1980? Answer: quite well. Stock market in both cases higher, 6 months all the way out to 4 years later. Average gain 4 years out, 45%. We all know there's no such thing as a free lunch in the stock market, so to get to the right side of the table, it's also helpful to know that the 1-year drawdown after the first instance was just a little bit under 3%. Second case, just a little bit under 5%. Both of those drawdowns occurred relatively quickly, roughly 45 calendar days from the date of the signal, which would be similar to this week. Hypothetically, if we experience similar drawdowns over the next 45 days, we'd come back into this area here between, let's say, 38.75 and 39.75. Not a prediction, simply gives us a reference point to manage against. And remember, this study was based on NYSE new highs minus new lows, and we performed the study after the close on April 5th. As of Thursday's close, it pushed even higher, and you can make an argument this is a mini short-term breath thrust here, similar to this mini thrust here that occurred back in November, and after that, you can see good things did happen in the S&P 500 index. Study number 2. Breadth indicator, we're looking at all the data going back to 1999 on the left side of your screen. S&P 500 stocks greater than their 50-day exponential moving average. As you can see, it's relatively rare to get all the way up into this area here. We did it during the breadth thrust off of the March 2020 low, and we just popped back up into that area again. We've only been this high 1, 2, 3, 4 previous times after coming from lower levels. And in the previous cases, which occurred in 2003, 2009, 2013, and back in June of 2020, for the most part, good things happened in the stock market. 9 months later, the average gain was 12.35%. 1 year later, the average gain was 10%. 2 years later, somewhere in the neighborhood of 21%. Also helpful to know, to get to the right side of the table in the historical cases, the average 12-month drawdown from the date of the signal was 4%. The median drawdown was 4.32%. The case that happened in June of last year, just a hair under 4%. In terms of the timing, kind of all over the place. One of them occurred 289 calendar days later. This one occurred 8 days later. Hypothetically, these drawdowns on a 2021 chart would take us back to these levels here, once again providing a probabilistic reference point. Study number 3. As we always say, this is not just a bunch of lines in a chart. This speaks to human behavior. In each one of these cases, oversold in 2002, way oversold in a rare manner in 2009. Oversold, the European debt crisis, 2011. This is October here. And back in 2020, this is the COVID low in March of last year. And in each case, the percentage of S&P 100 stocks greater than their 150-day simple moving average skyrocketed. This is a thrust. And we know from past videos that this tends to be helpful because technical analysis can only track the past. It cannot predict the future. We have to use our own intelligence to draw conclusions about what the past activity of some traders may say about the future activity of other traders. This is the past activity of some traders. In the historical cases, similar activity was followed by additional bullish behavior from a longer-term perspective from other traders, and those other traders pushed the markets even higher. Average gain 6 months out, a little over 7%, 9 months out, 9%, 1 year out. Nothing really to write home about, 10.66%, but still positive nonetheless. 2 years later, almost 20%, 3 years later, 30%. 4 years later, the average gain was an additional gain of 53.35%. Worst case scenario, the market tacked on an additional 47.5%. To get to the right side of the table, the drawdowns are really no picnic real time. These drawdowns seem normal when you watch the video here. If you're experiencing 4.5% drawdown in the S&P 500 real time, it's not a lot of fun. You have to remember, depending upon what you own, the drawdown in your own personal account could be quite a bit bigger than 4.5%. Recent example, NASDAQ, small caps, and banks all gave back quite a bit when the S&P 500, for the most part, was treading water or making new all-time highs. Study number 4. Similar concepts here. Last study was based on the S&P 100 index. This is a little broader. S&P 500 index. Stocks greater than their 150-day simple moving average. We're looking at all the data. It goes back to 2002. Relatively rare to see moves like this, 2009 up to here in the present day. Just hit the same area, the upper green line. This week we hit 94% on April 6th. You can see that's very, very rare going back and looking at this data set. This speaks to human behavior. This speaks to human behavior. This speaks to human behavior. And the quote inside of the blue box tells us why it can be important from a contingency planning perspective. We just showed that type of move, something that just happened on April 6, 2021, has only happened 2 previous times after the other signals one in 2009 and one in 2013. For the most part, good things happened in the stock market. Average gain 3 years later was 30%, 4 years later, roughly 52%. To get to the right side of the table, in the two historical cases, the drawdowns remind us, even in the context of the strongest bullish trends, givebacks, corrections, pullbacks, all of that are 100% normal and to be expected. The average maximum 1 year drawdown after these two signals here was 4.33%, and it occurred relatively quickly in 24 calendar days after the signal. Study number 5. We already covered one study in this video using S&P 500 stocks greater than their 50-day exponential moving average. This is a similar indicator. However, it looks at S&P 500 stocks greater than their 50-day simple moving average. We wanted to know, how rare was a move like this? Indicator was down here around 42, where my cursor is in late January of this year. This is really a form of a mini breath thrust here, where we get to the upper right-hand corner of the screen, and we're at 90. That move occurred in 69 calendar days. Thus, we thought it might be helpful to ask and answer, using all the data that we have going back to 2002, how many similar moves have occurred in less than 75 calendar days? The answer is 10 previous times, and if you know your market history, 2003, 2009, 2010, 2011, 2013, 2016, 2019, and 2020, May of 2020, those tend to be relatively bullish periods walking forward from an intermediate term to longer term perspective, and thus it's not particularly surprising that while it was a little bit of a mixed bag in the short run, longer term the stock market performed well. In every single case, the market was higher 2 years later. Worst case scenario was a gain of roughly 20%. The average gain 2 years out was 33%. The median gain was 35.34%. 5 years out, worst case scenario, a gain of 52.6%. That's an additional gain. Average gain, about 80%. Median gain, 79%. As we know, none of this predicts the future. It just helps us assess the probability of good things happening relative to the probability of bad things happening. How much pain to make it to the right side of the chart? If you're looking for a data set to help you keep an open mind about a wide range of outcomes, this is it. We have it. Something that just happened. The drawdowns are really all over the place. However, for the most part, every study that we've done in recent weeks tells us that the January 2021 low, from a probability perspective, could hold for the entire year. This data set agrees with that. Every drawdown, maximum drawdown looking out 12 months, held above this level hypothetically if we work backwards from the recent signal date. With one exception, and that's this case here, the pink horizontal line. That's one of the cases from 2010, thus it is relevant to the present day. But even still, you still come back to a logical area of support. This is the Vaccine Monday high. This is the September high from 2020. Not using this to predict anything, gives us logical reference points to understand bullish probabilities, normal pullbacks within the context of history, and abnormal pullbacks within the context of history that would shed light on longer-term bearish probabilities. Once again, if you want to keep an open mind about a wide range of outcomes, you have it right here. In terms of when the drawdowns occurred, pretty much all over the place in terms of calendar days from the date of the signal. The average drawdown, though, not too bad, 3.86%. The median, even better, 2.28, helping us keep a very open mind and helping us maintain maximum flexibility walking forward. This is the tech and growth segment here, but first let's look at 3 generic charts and see what we can learn. One of the great ways to make unbiased decisions about charts is to take the symbols off the charts. If we were taking a test, we would probably say this is clearly the chart that looks the healthiest relative to all 3 shown on your screen. This chart here last made a high in September of last year. Then it made a series of lower highs and eventually made a lower low and then retested that in this area here, dropped precipitously and is now somewhat bouncing back in a somewhat tepid manner. This chart here really hasn't done a whole lot, hasn't even made it back to this area here. And to try to reestablish an uptrend, it has to get into this area here and then start making a series of higher highs and higher lows. This chart's not as bad, but short term, we broke this trend line. We made a lower high and a lower low. Thus, to reestablish this uptrend here, very, very similar to this case, the price has got to get into this area here, break the trend line, make a higher low relative to this low, and then print a higher high, and better yet, print a series of higher highs and higher lows. All of that may happen over here, and all of that may happen over here. But as of 10:05 a.m. on April 9th, that's not about to happen. Not a lot of progress here. Same here. This bounce is relatively tepid. Hasn't even made it back to this line yet as of Friday's session at 10:02 a.m. So if we put the symbols back on these charts, this is where we start to learn something. Left side of the screen, VUG. It just printed a new all-time high. That's pretty good. However, relative to the market, not so good. A lot of work to do over here before we would get excited about growth stocks again. And maybe even worse, you can make an argument that this is just normal rotation. If we rotate from growth and tech to small caps, banks, and energy, pretty easy to say that's healthy rotation. But if we're rotating into defensive staples, then that's not really healthy rotation. That's defensive rotation and something that we need to keep an eye on. This chart really should be labeled growth stocks versus defensive staples. Is it possible that this chart's going to get up here and make a series of higher highs and higher lows? Is it possible this chart's going to get up here and make a series of higher highs and higher lows? We all know the answer. It's absolutely positively yes, and it may happen very soon, but it hasn't happened yet. So in terms of probabilities with tech and growth, hypothetically, even if this downtrend remains in place, growth could still run a long way here. This could be a relatively big move here. And this would be an area here, if we get back to this level, to watch the entire market, where you could possibly have the S&P 500 peak near this resistance area here, or if we get a failed breakout. All of that, not a prediction, just hypothetical. How about tech relative to growth? This is VUG divided by XLK. We don't even need to draw a trend line here. This is clearly still in a downtrend. So from a probability perspective, tech has done a better job righting itself relative to the broader growth stock area. If you like tech and growth, then you really want this chart and this chart to start to look more like this chart in the coming days, weeks, and months, and that falls into the to be determined category. If you follow along on Twitter, these graphs give this tweet some context. This is not a lot to be concerned about in the short run market. Hard to make an argument that a new all-time high is concerning. And a lot of ETFs, stock-based ETFs, are making new all-time highs. However, in this context, there's still a defensive bias in the tape, especially over here, so we would like to see this chart improve. And it may improve very, very soon, but once again, it hasn't improved yet. Now let's shift gears to the credit markets and see what we can learn. Chart of the 10-year yield, we showed these concentric circles in this video a few weeks ago and said this area may act as possible resistance. Thus far, we are stalled in that area. That doesn't mean we're going to stay there, but for now we are. Really what the question is here, interest rates, intermediate term rates and longer term rates, have moved a long way in a short period of time. And what we really want to know relative to the stock market, does that mean credit conditions are tightening and access to credit is becoming more difficult? If the answer is yes, that would be concerning. According to the Chicago Fed's National Financial Conditions Index, the answer to that question is no. Credit conditions are still relatively loose. This is what tightening credit conditions look like. This is increasing fear between counterparties. You're afraid somebody might not pay you back, or you're afraid that your bond might default. This is the financial crisis here where my cursor is. This is the spike in fear right here during the COVID plunge in the stock market last year. According to the Fed, positive values of the National Financial Conditions Index indicate financial conditions that are tighter than average. This is tighter than average. Low trust, low confidence that you're going to get paid back. Same thing here. We go above the zero line. Here's the recent trend. It may change, but right now, conditions are still very, very favorable in the credit markets, at least based on this reading as of April 2nd. How about credit spreads? Are we seeing signs of increasing fear about rising defaults? The answer is not yet. Here's our look here, data point as of April 7th. This is what increasing fear looks like during the COVID plunge in the stock market. Good to keep in mind. You can also make an argument that this is a form of complacency here. And sometimes, like the VIX, when these charts start to get a little sleepy down at lower levels, just like this period here, they can spike and things can move quickly. So that tells us it wouldn't be unusual, hypothetically, if the S&P 500 gained, let's say, an additional 2 to 3% from current levels, that on a spike or change in perception of future economic outcomes that could happen quickly, that 2 to 3% gain that we could experience in the next few weeks or months, hypothetically, could hypothetically be given back in 1 to 2 trading sessions, or in some cases, a matter of hours. That's not a prediction. It's just telling us when we see looks like this, we should probably pay a little bit closer attention. Right now, this chart looks fine. Nothing particularly alarming here, no spike. And this chart looks fine. Like every single chart that we cover in these videos, that is a statement based on the facts in front of us, the chart in front of us. All of that is subject to change, and all of that is subject to change sometimes at a relatively rapid rate, helping us keep an open mind about a wide range of outcomes, especially outcomes over the next 2 to 3 weeks to 2 to 3 months. Quick summary. 18 to 24 month outlook remains very favorable from a probability perspective. Look at the right side of the tables that we've covered in recent weeks. We have very little evidence in hand of impending longer-term gloom and doom. Said another way, very little evidence that a bear market is starting to kick off anytime soon. And that's a statement based on what we know today. However, in the short run, until the tape's defensive bias improves, we're going to respect that message. And everything we're talking about here is about our approach. Your approach may vary significantly. Experience says it is dangerous to rationalize away defensive undertones. It's very, very easy to look at this chart and say it's no big deal. It's very, very easy to look at this chart and say it's no big deal. But it is what it is at this point. This is the chart in front of us, and this is the chart in front of us. Also, very important to note, with this look and this look, even if they don't improve, markets can continue to rise for weeks or months with a defensive bias. What might that look like? We might gain another 100 points from here, another 2 to 3%. We have somewhat of a defensive rotation going on, and then the market has an intermediate term peak. And if that happens, the emphasis is on if, weeks of gains, meaning everything that we see in the next 2 to 3 weeks, can be given back in days or even hours after the peak is hit. We never want to assume anything, and we don't want to assume that the defensive bias is here to stay and very well could be removed. Thus, we have little reason for major concern in the short term. we also have very little reason to throw all caution to the wind. It's much, much harder to redeploy any cash that you have in the present day relative to November of last year. That was easy. And the fact that it's not easy today is telling us something. Very, very important not to get stuck on any story, including the story we just told. And the last study that we covered tells us to remain open to a wide range of outcomes looking out 12 months. So how do we handle all this? And once again, we means our approach under our system. When we wake up every day, we have to keep this important concept in mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.